Chapter 15, Succession Planning and Strategies for Harvesting and Ending the Venture. A lot of people don't start businesses thinking about the end, but they need to. So what's your exit strategy? Think about an exit strategy when starting a new venture. Is your exit strategy an initial public offering? Thus you go public, an IPO, private sales of stock, succession by a family member or non-family member, merger with another company, liquidation of the company, sale of the company to employees like an ESOP, or to an external source. Each exit strategy has its advantages and disadvantages. Now, a succession of a business. Transfer to family members is possible if the business survives into the second generation. There's 30% of them that do that, or a third generation, about 12% of them do that. A good succession plan should consider the role of the owner in the transition stage, family dynamics, the income of working family members and shareholders, the current business environment during the transition, and treatment of employees, of loyal employees that is, and tax consequences of this action. Succession by a family member can create internal problems because families get crazy. The entrepreneur should stay and act as an advisor at the very least. Now, transfer to non-family members. If the family members are uninterested in the business, you can train a key employee and retain some equity, retain control or hire a manager, sell the business outright. Passing the business to an employee ensures familiarity. The key issue is how much ownership the entrepreneur retains. If future succession by a family member is possible, hire a manager to run the business until they're ready for it, basically. Finding someone with the same manner and expertise may be difficult. Other problems are compatibility and willingness to manage without the promise of equity in the business in the long run. Either way, make sure you get an attorney involved. I don't care if it's family, non-family, whatever your exit strategy is. You need these contracts in place. Ideally, from day one where you start the business is how you will be able to dissolve the business or how a partner will be able to leave a business. You need to iron these things out early. Planning for non-family succession. Replacement for key managers may be internal or external. The partnership agreement may outline the process. Ideally, it does, as we were just saying. With a small number of shareholders, the succession plan should consider the following. Senior management of the company must be committed to the plan. Everybody must be aware, and there's no guesswork in it. There must be well-defined job descriptions and clear designation of skills needed to fill any or all of the positions. It must have an open process, and employees must be invited to participate. So the options for selling a business, a direct sale is a common method direct sale is a common method of unloading a business, if you will. If not necessary to sell immediately, consider these strategies. Develop a larger share in a small market niche. Keep costs under control and focus on higher profit margins. All these things make you more attractive, by the way. Get all financial statements in order. Prepare management documentation. Assess the condition of capital and equipment. Get tax advice. Good attorney, or you need to get attorney as well, but a good accountant. Get non-disclosures from key employees. Maintain a good management team and do advanced planning and preparation. Have a plan. You can sell directly, but even if you want to sell, you need all these things here. Direct sale. Buyers often purchase a business using notes based on future profits, but if the new owners fail, the seller may receive no payment and may have to take back the company. Business brokers may be helpful with their network of contacts. Business brokers are really helpful in a sale. Using a business plan to communicate the business to potential buyers. You're building a business plan in here. It's going to matter even when you're trying to get out of it. Selling to a larger company can provide resources to meet goals, and the sales agreement determines the entrepreneur's role after the sale, if any. An ESOP, an employee stock option plan. Under an employee stock option plan or an ESOP, the business is sold to employees over a set period of time. They slowly earn more and more stock until eventually the original owner owns no stock and they can walk away. The ESOP creates a legal entity for the purposes to reward employees and clarify succession. ESOP advantages: it offers a unique incentive to employees which can enhance motivation. It provides a mechanism to pay back employees loyal to the venture. It transfers the business under carefully written agreements. The company can deduct contributions to an ESOP and dividends. ESOPs are now possible for S corporations. So the biggest disadvantage of an ESOP are that they are complex to establish, but if you have a good attorney that's experienced in this, it's something that you can do. I don't know how many times in these 15 chapters I said, do not skimp on your attorney. Do not skimp on your accountant. They matter on these things. A management buyout, a direct sale to key employees, is simpler than an ESOP. It usually involves a direct sale for some predetermined price. To establish a price, appraise the assets, determine the value of the goodwill established from the past revenue, and what's the value of the brand and the community, etc. Sell to key employees can be for cash or financed in other ways. A cash sale is unlikely if the value is, pretty high, if the business is, has a substantial value. Financing can be done by a bank, or an entrepreneur may agree to carry a note, self-financed. Other method is to use stock as a method of transfer, but that's kind of like back to an ESOP, but only to a select group of managers. Stock is attractive to outside investors as the business is continuing with the same management team and there's continuity. So if it's successful, the more continuity, the better likely it is to maintain that success. Bankruptcy and overview. A new venture failure is not uncommon. The SBA estimates half of all new startups fail in their first years. The number of business bankruptcies has fallen after tightening of bankruptcy laws in 2005, so there's less people actually declaring bankruptcy to get a financial gain, which is a complicated process, but basically cutting corners. Business bankruptcies are divided into a few chapter filings. Chapter 7 bankruptcy is liquidation and the most common type of bankruptcy. So they're just going to liquidate all their assets to try to pay off as much of their debt as possible. Chapter 11 bankruptcy provides time to reorganize and prepare a new business plan, achieve new goals, and return to normal operations. So that's someone who wants to continue. Chapter 13 bankruptcy allows creditors to be repaid in installments, basically like payment plan to get out of debt in the long run. You're like, well, why would creditors do that? Well, if you took Chapter 7 as a creditor, if a business declares Chapter 7, they only get what you're able to sell off. So they're definitely going to take a hit on that, whereas Chapter 13, they'll get more, but over a longer time. And then if it's salvageable, Chapter 11 allows them to reorganize, adjust their plan, and hopefully become solvent. Bankruptcy is not always the end of a business, especially in Chapter 11. Lessons learned from experiencing bankruptcy. Many entrepreneurs try to diversify into markets where they lack knowledge and focus instead of focusing on known markets. Bankruptcy protects only from creditors, but not competitors. So competitors come after you while you're down. It is difficult to separate the entrepreneur from the business. Many entrepreneurs wait until it's too late. They go down with the ship. Bankruptcy is painful, and they share it with employees and others. The Bankruptcy Act of 1978 was designed to ensure fair distribution of assets to your creditors, protect debtors from unfair depletion of assets, and protect debtors from unfair demands by creditors. Now, let's look at the specifically Chapter 11, where we reorganize. So reorganization under Chapter 11 bankruptcy. Courts give the venture time to pay off their debts. New time constraints make it difficult for retail firms to reorganize effectively. A major creditor or group of creditors bring the case to court and can kind of tie you up there, only making your debt worse. A reorganization plan divides debt and ownership interests into two groups, those affected by the plan and those not affected. The U.S. Bankruptcy Court must approve the plan, which is generally a combination of an extension, a substitution, or a composition of those debts. Chapter 11 gives an opportunity to find a cure for any problem. Only a quarter of all firms filing for Chapter 11, so 25%, make it through the process, mostly from waiting too long before filing bankruptcy. So let's talk about surviving bankruptcy. Some suggestions for survival: use bankruptcy as a bargaining chip to voluntarily restructure. File before running out of cash or without any incoming revenue, Do not file Chapter 11 unless there's a realistic chance of recovery. Be prepared. Creditors will examine all financial transactions for the past year in seeking debtor fraud. So they're going to try to snag you on this because I guess they'd rather get that money up front. Maintain good records. It's always a must. Understand how protection against creditors works and how to keep it. Transfer any existing litigation to a bankruptcy court, and focus on preparing a realistic financial reorganization plan. So if you're going to go this route, you better have your ducks in a row. Preparation increases the likelihood of emerging from bankruptcy. So it sounds like having a plan is the plan, which is why we're making a business plan in this class that we hope doesn't end up in any form of bankruptcy. Chapter 13, bankruptcy, extended time payments. Filing Chapter 7, bankruptcy became more difficult in 2005, meaning you couldn't just bail. Entrepreneurs now required to repay some debt through Chapter 13, bankruptcy. Individuals must obtain credit counseling within 6 months and take a means test for eligibility for Chapter 7 or 13. There's a whole process for even how you can file bankruptcy. It feels like salt in the wound, right? The test states individuals may not file Chapter 7, again, this was revised in 2005, if the income is at or above the state income median. The individual creates a 5-year repayment plan with court supervision. A trustee receives the money and is responsible for paying the creditors on the entrepreneur's behalf. Chapter 7, full liquidation. This is the most extreme case of bankruptcy. This requires liquidation either voluntarily or involuntarily of all non-exempt assets. If the entrepreneur files a voluntary bankruptcy petition, it constitutes a determination that the venture is bankrupt. An involuntary bankruptcy can be complicated and takes a long time to resolve. It's like a hostile liquidation bankruptcy. Strategy during reorganization. Reorganization under Chapter 11 or 13 takes time. The entrepreneur can speed up the process by taking the initiative and preparing a plan, selling the plan to secured creditors, or convincing them of it, communicating with a group of creditors instead of avoiding them, not writing checks that cannot be covered, so responsible financial behavior. Improving credibility with creditors helps the venture emerge without a stigma of failure. Trust me, your creditor doesn't want you to fail, but if you start to fail, they're going to want to be paid. But as long as you're communicating with them, it's going to be a much more healthier process. Bankruptcy then should be a last resort. So keeping the venture going, not all bankruptcies have unfavorable endings. Be sensitive to the key factors that can reduce the risk of failure. Entrepreneurs must be aware that market conditions change, and they do, and they must be prepared to modify their business strategies. It's got to be nimble. That's why your business plan is such a living document, not like a one-time deal. It's always going to be updated and changed. Have good cash projections, as a cash flow is a major bankruptcy cause. We talked about that before in our financial chapter. Future market potential and forecasting is essential. Be wary of stress points. When a venture is changing in size, it may require new survival strategies. Identify stress points based on the amount of sales. Sales level burdens, capital investment, and operational expenses. Here's some warning signs of bankruptcy. Early warning signs are interrelated and can lead one to another. So management of finances becomes lax. So these are signs of bankruptcy. Directors cannot document large transactions. Yikes, that's scary. Customers are given large discounts to enhance payments because of poor cash flow. Contracts are accepted below standard amounts to generate cash. The bank requests subordination of its loans. Key personnel leave the company, and there is a lack of materials to meet orders. Payroll taxes are not paid. Suppliers demand payment in cash, and there's an increase in customer complaints. All these things are like telltale signs of financial woe. So, starting over. History shows that entrepreneurs may fail several times before succeeding. I would make the argument the only failure in entrepreneurship is the failure to learn. So make sure you learn from your own experience, but also others. Entrepreneurs are likely to start new ventures even after failing, learning from their mistakes. There you go. After failures, the entrepreneur has a better grasp on the need for market research, more initial capitalization, and a stronger business skills. Business failure does not have a stigma when seeking venture capital. It's what you learn from that failure and what you're going to do with it next. Now, a bunch of bankruptcies in a row is definitely going to have a stigma when you're dealing with venture capital. The reality of failure: many entrepreneurs turn failure into success because they learn from it. Some factors to consider: consult with your family, particularly your spouse. Seek outside assistance from professionals, friends, and business associates. Do not hang on to a venture continually draining resources. If the end is inevitable, move on. What do they say in Disney? Let it go, baby. Business turnarounds. The business may face adversity due to external factors such as the economy downturning, competition, changes in consumer needs, technology, and unpredictable acts. Some of these things can be self-inflicted due to poor management. Failing to plan is a plan to fail. Having bad employees and not doing anything about it is poor management. Some principles that help with a turnaround, rather. I don't know why I said rather. Some principles that help during turnaround, I should say. Recognize the warning signs of bankruptcy we talked about in a couple slides ago and consult with experts. Don't shell up. Don't get into your shell. Get out there and ask questions. Aggressive hands-on management is key. Be a leader. The management must have a plan in place based on 3 key questions. Where are we now? That's your situational analysis. Where are we going? Develop goals to turn the firm around. How do we get there? The turnaround process and action. So what are your action steps? Again, broad look at chapter 15 on exiting a business. And this brings us to the end of this textbook with our lectures. So it's been a fun ride. Feel free to let me know if you have any questions.